Welcome to this guide on dollar cost averaging, often shortened to DCA. This is a powerful systematic investment strategy that helps reduce timing risk in the market. Whether you are just starting your investment journey or looking to build wealth consistently, DCA offers a disciplined approach that takes the guesswork out of investing. Throughout this video, we will explore what DCA is, how it works, and why it might be the right strategy for your financial goals. Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of what is happening in the market. Instead of trying to predict whether prices will go up or down, you simply invest the same amount every week, month, or quarter. The beauty of this approach is that when prices are low, your fixed investment buys more shares. When prices are high, the same amount buys fewer shares. Over time, this naturally averages out your purchase price, often resulting in a lower cost per share than if you had tried to time the market. Let's look at a practical example to understand how DCA works. Imagine you invest $500 every month in a stock. In January, the price is $50 per share, so you buy 10 shares. In February, the price drops to $40, allowing you to purchase 12.5 shares with the same $500. In March, the price rises to $60, so you buy 8.3 shares. After 3 months, you have invested a total of $1,500 and purchased 30.8 shares. Your average cost per share is $48.78, which is actually lower than the simple average of the 3 monthly prices. This demonstrates how DCA helps you benefit from market volatility. Dollar cost averaging offers several important benefits. First, it reduces timing risk because you do not need to predict market highs and lows. Second, it promotes emotional discipline by removing emotion from your investment decisions. Instead of panicking during market downturns or getting overly excited during rallies, you stick to your plan. Third, it helps lower your average cost over time by automatically buying more shares when prices dip. Finally, DCA is incredibly easy to automate. You can set it up once and let it run, making it a true set-it-and-forget-it approach to building wealth. How does DCA compare to lump sum investing? With DCA, you spread your investment over time, which provides lower risk exposure and works particularly well in volatile markets. With lump sum investing, you invest all your money at once. While this can lead to higher potential returns, especially in rising markets, it also carries more risk. If you invest a large sum right before a market downturn, you could face significant losses. DCA protects against this scenario by spreading your purchases across different market conditions. The choice between the two depends on your risk tolerance, market outlook, and whether you have a large amount to invest upfront or prefer investing from regular income. DCA is particularly suitable in certain situations. It is ideal for new investors who are still building confidence and learning how markets work. The strategy shines during volatile markets when prices are swinging up and down unpredictably. If you have regular income, such as a monthly salary, DCA fits naturally into your financial routine by allowing you to invest a portion of each paycheck. Finally, risk-averse investors who prefer a gradual entry into the market over large one-time investments will find DCA appealing. It provides peace of mind by spreading risk and eliminating the pressure of trying to pick the perfect moment to invest. While DCA has many advantages, it is important to understand its potential drawbacks. In bull markets, where prices are consistently rising, DCA may underperform compared to lump sum investing because your money is not fully invested from the start. Transaction costs can also add up since you're making multiple purchases over time instead of one. Some brokers charge fees for each trade, which can eat into your returns. Additionally, with DCA, your capital remains uninvested for longer periods, which means you might miss out on potential gains during strong market uptrends. Understanding these limitations helps you make an informed decision about whether DCA aligns with your investment goals. Let's recap the key takeaways about dollar cost averaging. First, DCA removes the need to time the market perfectly, which is notoriously difficult even for professional investors. Second, it is best suited for long-term investors with regular income who can commit to investing consistently over time. Third, DCA provides emotional discipline and reduces the anxiety that often comes with investing, especially during market turbulence. Finally, always consider your personal goals, risk tolerance, and current market conditions when deciding if DCA is right for you. Remember, in long-term wealth building, consistency beats timing. By investing regularly and staying committed to your plan, you position yourself for financial success over time.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.